Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow.
That's me rocking out to the guitar riff. By the way, not that anybody cares, but when we first started doing the market call and the risk reversal podcast, we listened to like music riffs that you have to, like, what are they called, fillers or something? I don't know, maybe Jacob can text it to me. And that's the one we came up to. That.
By the way, one was worse than the next. Let's be really clear. Like, one was worse than the next.
But this is market call now. It's 11:01 on the East Coast, 8:01 on the West Coast. And if I sound a bit exorcised, it's because the New York Yankees, since I don't know, June 1st-ish, have been a horseshit baseball team. Yes, I said that. A horseshit baseball team. I think everybody is familiar with the Pale Hose of Chicago. That, of course, the Chicago White Sox, arguably one of the worst franchises in baseball over the last few years. Yet, since that period of time, both the Yankees and the aforementioned White Sox have the same amount of victories. Hard to really wrap one's head around it, but yet here we are. Yet another thing to wrap one's head around is the continued resilience of the U.S. equity market. As we sit here, we have an S&P, as Dan just said to me, about 100-ish or so points from its all-time high made 3 or so weeks ago. Seemingly everything, Dan, continues to come up roses. And we're going to look at a couple slides, but can I just read something from Doug Cat? Do you mind?
Go ahead.
No?
Go ahead.
You don't sound at all excited about this.
No, I'm excited. I love Doug.
No,
I do love Doug. He keeps things rolling here a little bit.
Well, Doug put out a piece about
disinfectant,
but he also put up a piece about the valuation of I can't find it. OpenAI, and he pointed out, the active users they apparently have, and how it's supposed to be a not-for-profit. I mean, we'll put it in the show notes. But I think what he's pointing out, and I don't want to speak for Doug, is just sort of the level of absurdity that things have reached. And that's anecdotal. I get it. But, we read story after story just like that, Dan.
Yeah. I mean, listen, there's two markets here, right? And when you think about, and I'm not talking just public and private, it really is like anything associated with generative AI. And, we know a huge driver over the last few years, as far as even in the economy, has been the CapEx that we've seen. It's probably close to $700 billion by maybe 6 companies or so. You know what they are. And then in the private markets, a lot of folks are not paying attention. And I think the thing that Doug's highlighting is that they're going to do OpenAI a secondary share sale at a $500 billion valuation. Now, they last raised at $300 billion. There was an institutional round. Each one of these rounds, folks are kind of tripping over each other to get in, which is something that we have not seen in a very long time, right? And not at this sort of scale. So I think that's one of the things that Doug is highlighting. A lot of these companies are not going to work out. A lot of the products that a company like OpenAI have, forget the not-for-profit thing. I mean, that is what it is. It was originally meant to, be this kind of open AI where it was almost like an open source company that was going to be developing benevolent AI, right? And so when they quickly saw this could be the sort of thing where they could make shit tons of money, they kind of changed their stripes a little bit. But I guess the valuations in the private markets, there's not a whole heck of a lot of transparency. There's not a lot of visibility on the revenue, on the KPI, all that sort of stuff. Now, companies like this, when they're doing these sorts of share sales, they do have to obviously offer up information. And I think the thing that you're referring to, there was an article suggesting that they're going to be at 700 million monthly actives or weekly actives, whatever the thing is. And, I had a conversation with Brett Winton, who's the chief futurist at ARK. It's going to drop in the Risk Reversal podcast feed Friday morning. And he's making the case that 700 million is just scratching the surface. We have 800 billion people on the planet. We have
not 800 billion, but yeah.
8 billion. Excuse me. 8 billion.
800 billion would be a problem.
Someday, but with the people aren't having kids anymore. But so you get my point, is that we're less than 10% of the population. Most of that population, 90 some people, percent of those people are on the internet. So again, I totally
I
get
get
what
it.
Doug's
I get it.
saying. It's not particularly like something that is actionable right now. Doug has this long series of tales of NVIDIA, and each day he's adding new sort of things that will ultimately be part of the mosaic when this thing digest, when the trade, when the theme is no longer investable at current valuations and the like here. So that is what it is. Guy, I want to put this up because I saw this gentleman on CNBC a couple days ago, or maybe even yesterday. And then in the odd lots, they have a newsletter that's Bloomberg. It's Joe Wiedenthal. And they do a weekly podcast twice a week or whatever, but they also write this newsletter. It's very good. I've been reading it for a while. So this is Neil Dada, I think. I don't know how you pronounce it. I don't know if you met him over the years, guys. He's been on he's been on CNBC. But this is interesting to me, okay, because there's a little something for everybody here. Given how strong the financial markets have been, the U.S. economy is innocent until proven guilty. I think you and I have been in that same camp, but we've also been pointing out that some of the hard data that's been coming in hasn't been particularly great. So here's his take right here. This is the bad and the good. The U.S. housing market is in a recession. We've been talking about that with weakening construction and declines in prices across major markets. This one, I'd love to get your take because it's also an inflation and a tariff situation, but then it's also an interest rate situation, and it's also a situation with a weakening consumer, with a massively overheated jobs market over the last few years. Let's just break these down one by one.
Well, the housing market, I mean, I'm not going to say whether or not it's in recession or not, but what I'll tell you is, inventories levels in terms of housing, the highest it's been in quite some time. Probably still a long way to go in terms of what's necessary, but that's trending the other way. Affordability, clearly a problem. 10-year, 30-year mortgage rates have recently ticked down, I think the lowest levels in a couple months, but those are still sort of difficult, I think, for people to wrap their head around. And it does come down to, in my opinion, I've been saying this for a while, as much as people want to make it about interest rates, which I think are going to continue to be sort of sticky and resilient, it's more about the health of the consumer, one, and whether or not people are still in jobs. Now, that job number we saw, we talked about it to death on Fast Money. We talked about it to death here. I mean, I think we're starting to trend in the entirely wrong direction. And the problem with that, in my opinion, is that once it starts, it hits sort of escape velocity. And regardless of what the Fed does to try to stem the tide, it's typically not going to work. Now, you could say they're going to be too late. It's fine. I don't think it matters how quick they are, how proactive they are. Once that genie's out of the bottle, it's out of the bottle for a period of time. And I think those are some of the headwinds that the housing market's going to face. Throw on top of that, the input costs continue to go higher just to make these homes in the form of these tariffs and what have you, and you got yourself a problem.
Yeah, and that's the number two. All right. So the consumer is sluggish. You've been highlighting that. You've been highlighting, some delinquencies on the credit front and the like. So not just auto loans, but also credit cards. So the labor market is showing fading momentum. We all got that very plain and simple on Friday morning, though there's no sign of a steep drop. Okay, well, let's see. And again, Neil is an economist, and I think he's probably got his finger on the pulse of that. So that's something that a lot of folks are going to be paying attention to. And AI-related investment has been significant. It's boosting growth, and there is no sign of this letting up anytime soon. All right, so this is the one let's parse out for a second, because we were just kind of alluding to this a little bit. So when you think about the markets, okay, so he just said, innocent until proven guilty, right? If we think about the contribution of CapEx and what that has meant to the technology ecosystem, right? And it's really been driving a lot of the performance in the S&P 500. The top 10 stocks make up, 35% of the weight of the S&P 500. They're also a huge component or a huge part of the earnings growth, right, in the S&P 500. So there's a lot of things there. So when you think about AI, I mean, listen, you could be knocking the CapEx. You could be knocking, how narrow this trade is. You could be knocking the return on investment that some of these companies are going to be getting in the near future. But at the end of the day, it has been a huge tailwind. And if we don't know when that's going to end, it's kind of difficult to keep, I guess, trying to, take shots at that as a pillar of a bear case for the market.
Now, and again, these stuff, and I think you said it earlier in terms of Doug note and in terms of this note, these are not timing mechanism by any stretch of the imagination, but it's just one more sort of, just throw one more sort of ingredient into this kettle that we've been sort of talking about. And at some point, these things do have ramifications. What I didn't mention 9 minutes ago, by the way, and that's on me. Yesterday, you and I joined Butters' podcast.
John Butters, he's the senior earnings analyst.
You don't have to say John Butters.
FactSet, he comes out with his earnings insight blog every Friday morning. You can have it in your in-mail or in your
in-mail,
there is, by the way, there is an expression for in-mail. And I think it's a local area network thing within companies. I think they call it.
Yes.
So that's where I was going.
No, my bad. I shouldn't have cast it.
You can have it in your inbox. Look at that. You go to factset.com/insight/subscribe. Yeah, we were on the Insight podcast with John Butters. We hosted. He gave us the 411. It was some good stuff, guy. We'll put it in the show notes.
We will. And we have Butters work today. So I did not want, and by the way, just to tease tomorrow, I think we've said it for a while, but if you halftime report fans out there, the 7 of you, there's Elizabeth Young Thomas.
Oh yeah.
Did you catch what I did?
Dude,
when I said that. Elizabeth Young Thomas will be joining for the first time since she had her baby. So that's exciting. And she'll be joining us tomorrow. So there's a lot to look forward to. Okay. Next slide, please. This is about Trump's tariffs.
Hold on. We might as well do Butters right here.
We want to do Butters now?
No, I think it's a good segue with what we were just talking about.
Listen,
right?
I'm always up for Butters.
Let's pull it up for a second here, because this is something actually we did not hit, Guy, yesterday in the podcast. But as we're getting to the tag ends, and we're going to hit retail because they're coming up in the next week and a half or so, and some of those stocks are performing very well today. But it's funny, it felt like in 23, it felt like in 24, the R word was on the tip of a lot of investors' tongues, a lot of economists, a lot of companies. They were just on recession watch, and we just haven't heard it a lot. And despite the fear about inflation being stoked by trade war and the like, so John's taking stock of basically what companies were saying on their earnings. The term recession has been cited on 14 earnings calls for the S&P 500 companies to date. This number is 89% below the number from the previous quarter, 124, and reflects 4% of the total number of earnings calls conducted to date. I mean, Guy, that's a little shocking. Maybe using the R word, recession, and scrolling for that word maybe isn't the appropriate way to think about it. But I know what John's doing here. He's basically saying here we had, a quarter of the companies in the S&P 500 last quarter speak of it. Now it's just basically gone away.
Well, I can do the math. 14 of 500 is 2.8%.
Wow.
See what I did there?
Yeah, right.
And I think, if I look at this slide and try to figure out what it means, as many people were talking about it at the height of the concern around recession, that was probably peak recession fears. And now, obviously, we're on the flip side of that sort of trough recession. Now, the question I think that begs to be asked and then subsequently answered is, does that mean, again, the way that people were sort of too emotional at its height, or people way too complacent now? And is it just sort of continues to be out there in the ether, and they're not mentioning it because, quite frankly, they'd probably be penalized if they did, because there are no right now recession concerns. So I'd look at this and say, you know what, this could be one of those counter indicators that we'll talk about in the months to come.
Well, it's interesting. So Peter Bookvar, our good friend, 1 Point BFG Advisors, was on Fast Money last night. And by the way, we're doing a weekly with Peter. We're calling it the Book Report. He's dropping in with us once a week and kind of giving us his macro dump, on just all the data and what he's looking for. And Peter,
the dump is really unfortunate. We should call it because he calls it the Book Report. We should call it bookmarked or something. I don't know.
Oh, I like that. It's BOOCK. You can make the argument that since June 1st, your Yankees have just basically taken a dump on.
That is a good use of dump.
Yeah, sorry about that. But you've heard that expression, data dump.
No, yeah. That's when they drop a lot of stuff on people.
Right.
You see it in
So
movies a lot of times when like a lawyer, I'm sorry,
yeah.
Dan, I apologize,
Go
but
go ahead. We're
when
feeling
one of these
feeling-
lawyers is working by him or herself trying to defend a client and they ask for discovery, they ask a
yeah.
big corporation that has 30 different lawyers for discovery. And then they say, okay, you want discovery? Here it is. And they bring
Bang.
in boxes and
Bang.
boxes of stuff. That's a
Yeah.
data dump.
Yeah. 100%. And it's basically saying, you want it,
You
here
got
you
it.
go. But by the way, which is one of the reasons why, if I were Palantir,
Mhm.
okay, and I had a $415 billion market
That's
cap,
what
and
they
I'm
have.
expected to have $5.5 billion in sales next year, okay,
Mhm.
and the stock has literally gone in the last year from $24, okay, or
You dump a
$25.
secondary on the market.
I would I would say, hey, people, you want our stock? Here you go. Choke on it. You know what I mean? And I'm going to throw $10 billion
And
on
well,
my balance
all right,
sheet.
so let's just that's first of all, you're right. Second of all, I would have said that $25-30 ago, but that's just me. But
Yeah.
let's just in a vacuum at $4 billion, excuse me, $400 billion. Let's just
By
take
the way,
this and say
425 as I'm looking
425
at it right
going
now.
up by the minute.
Yeah.
What would the appetite for something like that be? And in this environment would probably be extraordinary. And you use your stock as currency either to buy another corporation or buy something or to raise money because rainy days invariably do happen as much as it doesn't appear like that now.
Yeah. Well, listen, the question you just asked is a good one. Is like, okay, is this a retail driven thing right now? Or is it institutions buying this thing? I can't believe that this is institutions buying this because at some point I just don't know how you grow into this valuation, right? And so you think that there's certain parameters. Now there's another scenario here. So the top holders are Vanguard, BlackRock, State Street. Okay, we know who they are. They're all massive mutual fund and ETF complexes, right? And so they have bought this stuff to the tune of whatever indexes they're tracking and this and that, whatever. So it's the whole passive sort of thing. Those three companies make up 20% of the holdings, okay, of this. Sooner or later, there are parameters in which a lot of these companies that are not indexed, okay, like a lot of these, fund management companies will have to sell stock because it's becoming a huge percent of whatever portfolios they're in, that sort of thing. And then the fourth largest holder is Peter Thiel. He's got 3.1, he's one of the founders, percent of this thing. He has sold, well, he hasn't in a while, guy. Okay, as of a filing of Q3 24, okay, we can do the math. That's at least 9 months ago.
Mhm.
He sold 12 million shares, 12.5 million shares or so. You got to think that, some of these guys, maybe his kids need braces or tuition or something like that. Maybe like take a little off the top
Braces.
there. You know what I
Yeah.
mean? Like, everyone's got expenses. You know what I'm saying? So, and he's one of those guys. I think he was buying like an island in New Zealand, not the island of New Zealand, but he was buying an
Well, he
island.
probably could.
It was like a bunker sort of situation or whatever. But, sooner or later, like gravity takes hold, and I had Brett Winton, as I said, from ARK. This is one of their holdings in the ARK Innovation Fund. And I'm like, listen, man, like, in what planet, like, have you ever owned a publicly traded stock that trades at 100 times sales? Now you could say, well, there's this $2 billion market cap company or something like that, and they're going to cure cancer. It's a biotech or this, you know what I mean? Like, but not at this scale. And so that's kind of the point. And, I don't want to be contrarian for the sake of being contrarian, but, and I'm going to say it again, this is the dumbest fucking stock I have seen in my nearly 30 years in the market. It's dumber than Qualcomm and Nortel and Lucent and Yahoo and Global Crossing and all those other shitty companies that basically went to zero after the 99 thing. Those, people don't get it. The NASDAQ went up 85%, but it was built on the foundation of shitty companies that had metrics like this. It wasn't built on what is going on with NVIDIA and Microsoft and, a handful of Meta and stuff like that. These are real companies. And these are real growth, and these are getting, that all that sort of stuff. So do you understand where I'm getting at?
I do.
This is the dumbest stock I've ever seen in the stock market in nearly 3 decades.
Okay, before we get to John's second slide, let me just sort of throw something else in the mix.
Yeah.
Alex Karp, I think we all agree. I mean,
Dr. Karp.
Well, that's going to be what I was going to say
Oh,
next.
really?
So now it's Dr. Karp. Now he's been for quite some time, but now he needs to be referred to as, which is his right. I mean, he earned a degree, but that's something new. And the hubris and the arrogance on some of these calls is worth noting. Now's the time, I think. The time to flex is when everybody's shooting against you. The time to be humble is when everybody's in your court, and he sort of flipped it around a little bit. So throw that in the mix as well. And, it's all part and parcel to what you're saying.
Well, I think you and I were watching the same thing then on CNBC last night, right before Fast Money. I was in a chair getting a little makeup. I don't need a lot of makeup, obviously.
No, of course.
Look at the money
great
maker
hair
here.
too.
You know what I mean? Yeah, I mean, whatever. But this guy who was one of the founders, I guess, and of Palantir going back, 15 years ago, he kept on calling him Dr. Karp, Dr. Karp, Dr. Karp. And I was like, okay, you know what?
Lighten up, Francis.
I'm sure he's a lovely guy.
I say that all the time.
I know you do. All right. So, John, guys, you remember? So John Butters, he's the senior earnings analyst
we've been through
over
this,
at FactSet. He comes out with the Earnings Insight blog every Friday. We get to preview it on the market call. So we just went through a little bit. Oh, there you go. FactSet.com/insight/subscribe. If you want that in your inbox every Friday morning, go there, subscribe. All right, let's talk about this. So we just talked about recession. I mean, that is pretty shocking, like just quarter over quarter, the decline in companies talking about it. Okay. At the sector level, the financials, 5, and industrials, 5 sectors have the highest number of earnings calls citing recession to date. So 5 in the financials and 5 in the industrials. Okay. In 7 of the 10 sectors, no S&P 500 companies have cited the term recession on their earnings calls. Okay. Talk to me about that.
This makes sense to me. The sectors that should sort of theoretically have their finger most on the pulse are financials and industrials. If you think about sort of the cyclicality around both those sectors. So it clearly makes sense. Real estate makes sense to me to a certain extent. Same type of argument. Energy seems to be sort of lost in the abyss. So the companies, the sectors make sense to me, but I'll go and say it again. The magnitude that they're talking about it does not make, well, in some ways it makes a lot of sense to me. In other ways, it's sort of that counter thing. So again, financials, industrials, most cyclical, most likely to have their finger on the pulse. It makes sense. I'm just shocked that the number is not higher.
Yeah. And we went through a lot of other data with John on that podcast yesterday. So we will put the link in the show notes. It was a great conversation. It took 15 minutes and John was presenting the data and Guy and I were going back and forth with it and a lot of good stuff there, especially as we're, through the end of most of the big tech, the financials, industrials, that sort of thing. We're going to get into a lot of the consumer, the retail stuff. But guys, let's look at what's going on in retail today. So look at Walmart. And we highlighted this yesterday, this consolidation. We highlighted the fact that the stock had not confirmed the new highs in the S&P 500. And here you go. I mean, this is a big breakout of a range here. And what did your prom date used to say? The longer the base, the higher
in outer space. Don't make fun of Louise Yamada. She might be watching right now.
She is on the Mount Rushmore guy.
Yes. So let's break that. First of all, your Target is having a day as well. I think it's trading like 105 and change. And you highlighted Target about a week and a half ago. I think the stock was trading like 98, 99 at the time. So you were spot on. Walmart. Let's just break this down for a second. Stock made its all-time high back in February. Into earnings, we both said that you got to be really careful here. It was valuation was going to sort of get in the way. It was due for a pullback. It got down to 93, I think, right after earnings. The subsequent move in April, I will be honest with you, I did not see coming. Yeah. I think it traded down to like $80 ish. Let's just say ish. Then there was a period of time as the stock rallied, it sort of hit a wall. And I think, I don't know, maybe middle of May into June, CNBC started running these graphics that Walmart's on a 10-day losing streak or something. And that was statistically true. But what I pointed out was, although it's on a 10-day losing streak, it's really not losing all that much on a day-to-day basis. And it was still within sort of shouting distance at an all-time high. And I took that as very constructive. Now, today, it appears to be right. Trading 102 and change, and we're within $2 or $3 of an all-time high. And I will say again, Walmart is a name that, despite valuation, which is problematic, I think can continue to go higher here.
Yeah, I mean, it's just curious price action, to be very frank. I mean, I don't really see much going on in the name is by way of analyst commentary or something as it relates to data that would suggest that staples or their pricing power or, all that sort of stuff. So again, it's just worth highlighting. And then the group in general is a huge outperformer today. We have Costco, you just mentioned Target. There's a handful of others. Consumer discretionary like Nike is up here. Your Dick's is up 2%. And then
one of the funniest, I don't know if we can put that clip in the show notes. I'll find it, because that was one of the funniest. I'll save it for the show.
From Fast Money, is that what you're dealing with? Yeah.
But without saying a word,
yeah.
I don't know if Bill Hockman is listening or watching. He might be reading Kant or something.
Like 7 feet away from me.
That's Immanuel Kant, by the way, for you playing our home games. That was one of the funniest things I've ever seen. And without me even uttering a sound, it really was quite amusing.
All right. So I'll just break it down. Every quarter, every company that's listed, they report earnings, right?
Yeah.
And so,
I'm going to try. You keep talking. I'm going to find this, by the way.
Really? Okay. Yeah. So we've been doing this thing where Dick's reports, and, usually we'll go around the horn on retail. If Karen's there, we'll start with Karen because she's big into retail. And then, Tim will get in there and say something like that. And then, Guy might have and then usually, and I've done this probably a dozen times over the last few years, I'll be like, I know Tim likes Dick's here, and then I'll go into a Best Buy or something like that also reported. And usually there's some folks on the desk who are biting their lip a little bit or whatever. All right. So Melissa is also in on the joke, Guy, right? And so there was one day, I think, was it last quarter or 2 quarters ago? And what did she say? Because we were going through the retail.
I just said it, Jacob. Again, I'm sorry. I really do apologize, but this is why we do these shows. You got a little fun.
Did he put the video up there?
I just sent it to Jacob. I don't know if Bill. I just sent it to Bill as well. I am telling you, Jacob. Just text me if you can do this. I don't know how the whole technology thing works.
The whole technology.
But if you can, this was just.
Yeah, it was funny stuff. And that's why you watch a program like CNBC's Fast Money.
Is Bill laughing right now?
This and that or whatever.
Jacob is saying something. Efforting. He's saying efforting. Okay. So as we effort that, you're right to point out this move in the consumer stocks, which comes on the backdrop of a lot of, you read some of these delinquency reports and the state of the consumer strapped, and we'll talk about it maybe tomorrow with Elizabeth Young Thomas. Some of these delinquency rates are levels we haven't seen in quite some time. Now, Situation Room has a question, and we're not burying the lead. We both know that Apple is up significantly today on that announcement, and we have the slide for that. So let's slide that, Earl, because to me, this is one of those things, Dan. You get calls a lot of time like, put me on your podcast, do this, blah, 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 blah. And at a certain point, you just sort of acquiesce because you just can't listen to them browbeat you anymore. To a certain extent, and this is just me, I think that's sort of what's going on with Apple and some of these companies. Just promise the administration the world in terms of investment. You get them off your back. Whether or not it comes to fruition almost doesn't even matter. But I think the stock is rallying today on the back of that because I think there's a perception. People connect the dots and say, okay, Apple's going to bend a little bit here, which means the administration's going to bend a little bit on the other side, and maybe they're out of the crosshairs.
All right, so let's just break down what's going on. So a few months ago, probably shortly after the inauguration, a lot of these CEOs were kind of going to the White House, and for some reason, the magic number was 500 $500 billion that they were going to invest over the next 4 years in the U.S. Okay. They were also talking, about diversifying away from Chinese manufacturing, which is something that had been ongoing over the last
few
years. They
had been doing that.
COVID. Okay. But here's the thing. Here's the rub with Apple. They were moving a bunch of their iPhone production to India. When I say a bunch, we're talking about, I think it was less than, 20% or something like that. The problem here with this announcement today, $100 billion to do what? To kind of diversify their supply chain back to America. The only reason Apple saw like an acceleration in iPhone sales in the quarter they just reported is because two things. One, people were rushing to buy them early in the quarter. And Tim Cook said this, go listen to the transcript, which I did, okay, prior to tariffs. So this is primarily in North America, prior to tariffs coming into effect. Okay, that's A. B, they saw a reacceleration in China, which has been very bad for them over the last, call it, couple years or so. And part of that had to do with the fact that the Chinese government is trying to put in stimulus for consumers, and the iPhone was in a list of products that were were able to get subsidies from the government. So people were going and buying iPhones in China. Now you could make the argument that the likelihood of those consumer subsidies, especially for a company like Apple, if we have a protracted trade war, are going to go away, A, and B, the whole idea that we're going to reorient. And don't forget about this. Tim Cook, under Steve Jobs, was the one for the last 25 years had been putting together this supply chain network in China for low-cost production, right? So the idea that you're just going to break that all down and reorient it a bunch in the U.S., it just doesn't make any sense, because that is going to be the thing also that drives up prices. The last thing I'll say, on the call, they were talking about AI, and they were going out of their way to list all of the products that they did not invent. They didn't invent the iPod. They didn't invent, the iPhone, a whole host of other things. But when they got into the space, they did it a lot better and took a lot of market share.
And that's been their path. Yeah, I think and good for them.
But
Let
that's
people
what
innovate.
they're going to do with AI. The big difference is they were great at hardware. They were great at the integration of software. But a lot of what's going on in the AI space right now has an eye towards not being dependent on a smartphone, right? There's a whole host of other things. It's one of the reasons why OpenAI did the deal. What was it? A $6.5 billion deal in acqui-hire to get Johnny Ive, who was basically the design chief of all those devices we just talked about. And make no mistake about it, they are not building an iPhone competitor in the smartphone space. Okay. So the fact that Apple is up 5.5% today off that headline, it just makes you think that we are getting a little bit into bubble mode, because there's nothing good going on there. And the last thing, I promise, the last thing about Apple is that you ready for what they committed, and they said their CapEx is going to be, Guy, throw it out there for the next year. Give me a number that you think in this war of CapEx wars among
they probably committed to $35 billion in CapEx.
All right, you ready for this? $4 billion. $4 billion is half of what Google just raised their CapEx. You know what I mean? Like half.
Yeah.
Raised it off of a 80 billion base, or maybe it was half of Microsoft off an 80 billion.
No, but that's why I thought it would be like half of the big.
Right.
Wow.
Okay. So this company, like even today, you just look at it from a technical basis, this thing has not sniffed its 200-day moving average since it broke below it in early April with the tariffs. So there's a lot of different things going on here. I know that was a rant. I know there was a lot going on there, but this is one, to me, I see no reason to chase, especially if these tariffs remain on, by the way, not just on China. So Trump this morning is putting a 50% tariff on items that are coming from India. So if you are making iPhones in India, which they're trying to do more of, and you're shipping them to the US, well, you tell me, like, what's an iPhone if the average selling price is like $1,200 and you're going to put a 50% tariff on from India? Well, you're not going to be able to make them here in the US. They have to be made somewhere else, like outside the US right now. So I think it's a big fugazi.
I'm with you, Doug. By the way, Jacob has the clip. So this is hopefully the sound is on. So without further ado.
And Estee Lauder is not, but often I find that an interesting trade.
Nobody wants to talk about dicks? No, I'm serious. I mean, there's
that is something
well, look, I mean, the revenue, it was a 2.8% in terms of sales.
All right. So Guy and I and Tim, I think we left that show. I had a lip that was bleeding. I don't know. Was your lip bleeding a little bit? Like
Well, you
that's
see, I mean, Bill, it's Bill. I got to believe that Bill is snickering at that because that's some funny stuff right there. I mean, that is some high-end funny stuff right there. Just
Yeah.
keeping it together in the face of that's like standing in the pocket with, the defensive lineman. It's surrounding you, yet keeping your composure, and that's what I think I did there. I'm high grades for me for sure.
That was amazing.
By the way, the laughter you hear in the background, for those really that want to get into the weeds here, I think that was the TRB that filmed that and sent it to me. So
that
that's
would be
him
the
laughing.
Reform Broker. That is Josh Brown, friend of the show. You know what I love about Josh is that he appreciates a good little, you know what I mean?
He does.
A good little thing like that. You know what I mean? Like, so
As do I.
yeah, that was
We
fun.
don't take ourselves that seriously.
Well, I mean, listen, you have a philosophy about that, and I think it's really important because you can turn on. No one has fun on the news anymore. Let's be clear about that. There's
Well,
nothing.
I mean,
fun.
there's not a lot of fun
There's
things out
nothing
there.
fun in the news. There's no. It's actually not even appropriate if you are on Fox or CNN or MSNBC or whatever. Like, because the news sucks, no matter what side you're looking at it from. Like, we can all be clear on that. So, financial news is kind of interesting because you and I have always known this is like. Okay, when it comes to people's money, they take it very seriously, but it can also get in the weeds, and math sometimes sucks. And markets, as we kind of describe here, they don't often make a lot of sense. You know what I mean? So the idea of shedding some light on that, I think, is kind of fun. Don't you think so, Guy?
I do. And again, people, all the stuff that's talked about, if you wanted to get it in a very granular form, it's there for you. So if you want to get it vis-a-vis a visual medium, you got to provide people with what I feel to be some little entertainment, some just vignettes, some levity from time to time. You know what else is entertaining, by the way, getting back to the market, is McDonald's. And this is what we have been pretty consistent about. As large a company as this is, and show the chart, what we have pointed out is the volatility in the shares over the last couple of years. Go broader than that, and you'll see exactly what I'm talking about. In what is a lower left to upper right chart, look at the moves to the downside we have seen over the last few years. And that's going back to the spring of 2021, or let's call it the winter of 2021. I mean, the downside moves have been precipitous, but have been followed by the next leg higher. And it continues. If you look outside of a little sort of hiccup in April, it's been a series of higher lows and higher highs. And I think that pattern has not been broken. And I think we've been pretty consistent on this. Every time you've seen sell-offs of the magnitude we've seen over the last month or so, it gives you a shot to get back into McDonald's. And I do think, this is just me, the all-time high in the name, I think, is 326-ish. You can probably find it for yourself. But I think we're going to take that out vis-a-vis this quarter.
Okay. I mean, listen, if you can string along that whole idea of the whole idea of consumer staple-ish, right? And so Tim said this on the show last night, that this is a company that they can really compete in an environment like this on price. And we've been talking about Chipotle. I don't know what the average ticket size there, but it's probably $15. You know what I mean? But the one thing in a city like New York, and we were doing this one segment when we were on Fast Money, I want to say a couple months ago, go to the website and like try to order McDonald's, you know what I mean? In a city like New York City, it's like $13 for like burger, fries, and a drink or something like that. It's not cheap anymore, So it's butting up against some of those bowl companies.
If you were to go to McDonald's, understanding that you live in the city, so this is tough to answer, but do you sit in the restaurant or do you get it sort of to go, eat it in the car, like, or as you walk on the street with a cheeseburger in your hand? Like, how does that work?
The only time I get McDonald's every once in a while as I'm rolling out of a concert at MSG and walking down the street and that sort of thing. And maybe, like there's a contact high going on from the concert or something like that. I actually, Bill's like waving it in. In that scenario, I'm not sitting in McDonald's. The last thing you want to do is sit in a McDonald's on 8th Avenue in the 20s at like 11:30 at night. I actually have not been into a McDonald's and bought McDonald's, I want to say, sadly, in a couple of years. I love a quarter pounder with cheese, fries, and an orange drink. Maybe something from the
orange drink.
maybe something from the McNugget family, maybe a 10
Do you
piece.
know this? I know Bill Hockman knows this. I guarantee Jacob knows it. And CC, Timmy probably, we all should know this.
The whole team knows.
Do you know that McDonald's, all the restaurants are configured very similarly, and the seats are built in such a way that they will make you very uncomfortable somewhere between the 12 and 15-minute bucket of time. And that's done by design because they don't want people lingering. Now, for you Cranberry fans out there, you will know that
Do you have to let it linger? Do you have to let it linger?
Linger by the Cranberries. Of course, the great Dolores O'Riordan, who passed away a few years ago. She was one of the largest landowners on the island of Ireland.
Really? I did not know that. Hey, let's because I know we don't have a ton of time here, but I want to rip through some stuff. No. I mean, we've been a little goofy here, but hopefully you guys have enjoyed it. Hopefully we appreciate.
I've enjoyed it.
All right, so let's look at some earnings movers, guys, really quickly, because we've been highlighting the fact over the last few weeks, really since the bank earnings, that there weren't too many stocks that have been outperforming. Obviously that move in Meta was pretty
significant, and Microsoft too.
And then there was Reddit late last week. There was probably a handful of others. But let's pull up this slide. This is just today. And these are some names that maybe you haven't spent a lot of time looking at, but Astera, Klaviyo, those were all IPOs, I want to say, a couple years ago. Shopify, and we're going to pull up Shopify in a second. So these are all the upside. Zeta, which is a company a good friend of mine is the CEO. Just full disclosure, that thing is up 25% today. Good quarter, good beat, all this stuff. But then on the downside, Snap is what it is. Dave is a fintech company. AMD, I know we can talk about a little bit, down 9%, but I think you said it yesterday. The run into the print made it almost impossible for this company, for the stock. And then Open Door, which was like a meme stock. It's a $2 stock. Who gives a shit? Let's go to SMCI, because this is one that, this is a server maker, right? That goes into the data centers, that trains the model. You got the whole thing, right? And, when I think about this, big competitor of theirs, we've been talking about this, there's SEC investigations, their margin structure is so much worse, half that of Dell, which is their major competitor. So this is a disappointing quarter, and the disappointing guy, the commentary not great. So you look at this stock, down 20%. I'll just mention this guy. I don't know if you've checked out the CoreWeave today. So CoreWeave is down 3.5%. Dell's down 2%. So I think that's an interesting data point. I'm not saying go out and sell data centers, this and whatever, but it's worth noting. And Dell doesn't report for, I want to say, a week and a half or so. That's going to be very interesting to me, guys.
Okay, so real quick, Super Micro, for those that are looking to trade this thing, if Jacob and or Steven can draw an uptrend line from November low, you will see that we are fast approaching support. And if you were to draw that uptrend, the support probably coincides with where the 200-day moving average is. And that's just my eyes. Look at, I tell you what, man,
so good at this.
I really am pretty effing good at that, right? You will also see that these highs that we traded up to, the $60 level, was sort of the high earlier this year, and it was a prior high, I think, in the fall of 2024 or so. So you're getting towards what is going to be pretty significant support here in Super Micro, without question. Quickly, in terms of AMD, the valuation, I guess, in today's world is excessive but not ridiculous. The problem is, and we outlined this, the move since April, and I think we traded down, you probably have it in front of you, $77. I mean, the stock was up 120 something percent into this, it's just a staggering move for, again, what's not an insignificant company. It's probably a $250 billion company. So it made sense. I don't think the quarter was a disaster by any stretch, but to me, it makes sense that it's taken a breather here.
Yeah, and I want to do the same thing that you just did with Dell for a second here. And so this is going to be interesting. Let me just kind of pull up when Dell reports. 28th. Okay, so it's in and around the NVIDIA report, and you just draw that uptrend. This is purely technical. Obviously, you see that flat 200-day moving average. I mean, I would expect it to test that. That's 113. Maybe as we get into earnings on that
Dell trade.
What's that? Yeah, we'll do that maybe next week. In the options, guy, in the options.
Yeah.
So this is one that I think if you want to pull it, you draw that uptrend, the flat 200-day. There's no reason why it could not come back into that consolidation. And listen, I guess the other way to think about it, you started off the program by saying 100 points away from that prior all-time high in the S&P 500. We're going to get out of Q2 earnings season where there was no major disasters. There was nothing here that led you to believe that the financials are going and imploding, and consumers doing this and that sort of thing. Still a lot of just like lack of clarity in and around tariffs. And when the Trump is like throwing out new tariffs on India or this, that, whatever, it does kind of put some pressure on, I think, the visibility of a lot of these companies, you know what I mean, who are looking to do CapEx and R&D. And I think the last thing we haven't even mentioned is that, what does that mean for hiring? And there's a situation here where you could see a slump in hiring. The government's been cutting workers via Doge. We have companies that are cutting workers because of AI. Every day I see a new story about the AI, job cuts are only going to be accelerating, that sort of thing. So a lot of stuff going on there. A lot of stuff on the hiring front.
I like what you did there. A good way to sort of summarize it. I had fun. I mean, it's 45 minutes into this thing. I had a blast. I don't know if the audience did, but we try to make it fun because what are we doing here? It's Wednesday. Today was Butters. Tomorrow is Elizabeth Young Thomas. We have some podcasts dropping left and right, which it's we talk to people at a furious pace.
Yeah, so we have tomorrow we're going to have an extended one with Liz. You're going to get to see all the visuals, everything we do on the market call, but then we're going to have a bit of an extended what do we call that? What are we going to call it? A bonus that's going to go in the Risk Official podcast with Liz. And then Friday morning, Brett Winton from ARK Invest. We had a fun conversation back and forth. I think you'll be able to see some of the things that maybe I don't agree with, but he's a genius, went to MIT, he's a well-trained analyst, strategist, futurist. And then we are speaking Friday to David Rosenberg. You just call him Rosie from Rosenberg Research. That's going to drop Monday morning in the Risk Versal podcast.
He's all hot and bothered. And when he gets hot and bothered, you want to hear what he has to say.
Well, there's two guys that like when like the BLS firing, that sort of thing. Doug had a great write-up on the Street Pro. And Rosie did too. And Rosie had written an open letter to Trump about tariffs and the like. And I don't know if Trump read it, but I read it. I thought it was really good. So we're going to go over all that on Friday. Drops Monday. Thanks everyone for being here. We got Liz Young Thomas tomorrow. Can't wait.